Did you know there are many smart superannuation strategies that cut your tax bill? It's not just for the wealthy or elderly, it suits different incomes and ages. In this video, I'm going to show you 7 superannuation strategies to legally pay less tax in Australia. The last one alone has a potential to save almost $70,000 in personal income tax for financial year 24. Let's dive in. Strategy number 1, spouse super contribution. This is when one partner adds money to their spouse superannuation account. This can help boost the receiving spouse retirement savings and may provide the contributing partner with a nice tax saving through a tax offset. The maximum tax offset the contributing partner can get is $540. This happens when the receiving partner's income is less than $37,000 and the contribution amount is at least $3,000. If the receiving partner earns more, the tax benefit decreases until it cuts off once their income reaches $40,000. If the contribution is less than $3,000, the tax offset also shrinks. If one partner in a couple earns less than $40,000, it's worthwhile looking into the details of this strategy. Strategy number 2, government co-contribution. Government co-contribution does not give you extra money on hand, but it's like free money for your super from the government. For financial year 24, the maximum benefit is $500 contributed by the government to your super if you make $1,000 after-tax non-concessional contribution to your super and your income is under $43,445. The exact co-contribution amount depends on how much you contribute and your income. The government matches the contribution at a rate of 50%. The maximum co-contribution of $500 gradually decreases and disappears once your income reaches $58,445. You can use a super co-contribution calculator on the ATO's website to estimate your co-contribution entitlement and eligibility. So in FY24, if you earn less than $58,445, it's worth looking into the details of this strategy. For FY25, the maximum co-contribution benefit remains the same at $500, but the lower and upper income threshold increases to $45,400 and $60,400 respectively. Strategy number 3 to number 7 fall under the umbrella of before tax concessional contributions, ranging from beginner to master strategist level. Let's start with the basics. Strategy number 3, salary sacrifice. Salary sacrifice is one of the 2 ways to make before tax concessional contributions to super. Instead of taking all your pay into your pocket, you can ask your employer to put part of it straight into your super. This can help you save tax and build your super faster. A quick example, let's say your taxable income in FY24 is $100,000. With a marginal tax rate of 32.5% plus a 2% Medicare levy, you would pay $24,967 in tax, leaving you with a take-home pay of $75,033. If you salary sacrifice $10,000 into your super, you would only need to pay personal income tax on $90,000. In this case, you would pay $21,517 in tax. The $10,000 you salary sacrifice to super is taxed at 15% inside super, which amounts to $1,500 in contribution tax. By using salary sacrifice, you save $3,450 in personal income tax. You save $1,950 in total tax. Your take-home pay decreases by $6,550 and your super balance increases by $8,500. Strategy number 4, personal deductible super contribution. This is a second way to make a before tax concessional contribution to super. It enjoys the same tax benefits as salary sacrifice. Instead of having your employer take money out of your pay to put into super, you can use your own savings to directly contribute to super. Just make sure to complete a valid notice of intent to claim a tax deduction and get acknowledgement from your super. If you are between 18 and 67, you easily qualify for this strategy. For those outside this age group, there are a few extra eligibility criteria. The personal deductible super contribution counts towards your concessional contribution cap, which is a very important concept to get right. This cap also includes super guarantee and salary sacrifice. The general concessional contribution cap is a max amount of before-tax contributions you can add to your super each financial year without triggering any other rules. For FY24, it is $27,500 and it will increase to $30,000 for financial year 25. Strategy number 5, First Home Super Saver Scheme. If you are a first home buyer, you should know about this government scheme. It allows you to withdraw extra contributions you made to your super since 1st of July 2017 and use them as a deposit for your first home. Only voluntary contributions are eligible for withdrawal, such as salary sacrifice and personal contributions. You can apply to withdraw a maximum of $15,000 of your voluntary contributions from any single financial year, and up to a total of $50,000 in contributions across all years. Technically, you can make both concessional contributions and non-concessional contributions, but for most people, concessional contributions are the ones to provide tax benefits. Let's assume a couple, both first home buyers, each use the First Home Super Saver Scheme to the maximum, contributing $50,000 as concessional contributions across all years. If their marginal tax rate remains the same during the contribution and withdrawal years, they will benefit from a total tax savings of $15,000. This provides a 15% uplift to the part of the home deposit they save through this scheme. If you want to learn more about this strategy, check out my other deep dive videos on the topic. If you found this video valuable so far, please like and subscribe, but get ready because we're about to take it to the next level. Strategy number 6, carry forward concessional contributions. Building on strategy number 4, personal deductible super contributions, if your total super balance is less than $500,000 as of 30th of June of the previous financial year, you may be eligible to contribute more than the general concessional contribution cap by using any unused concessional cap from previous financial years. This is called carry forward concessional contribution. You can carry forward any unused concessional contribution cap from 1st of July 2018 for up to 5 years. This means any unused concessional contribution cap amount from financial year 19 that is not used by the end of financial year 24 will expire. A good way to check your unused concessional contribution cap and your total super balance is through MyGov ATO. The maximum one can contribute in this financial year 24 is $157,500 if their super balance as of 30th of June 2023 is less than $500,000 and they haven't made any concessional contributions since FY19. This figure of $157,500 is the maximum amount, and it includes 6 years worth of concessional contribution caps, 5 years of unused caps, and the current year's cap. This strategy is very useful for someone who has one-off high-income event, such as selling an investment property. Let's take a look at an example. John, age 60, retired 10 years ago. In FY24, he sold the investment property that he had held for 10 years. With no other income, John has a capital gains of $358,768. Even though this is a significant income year for him, he can utilize the carry forward super contribution rule to make a larger personal deductible super contribution, bringing his taxable income down to the effective tax-free threshold and paying zero tax. How? Since he held the investment property for more than 12 months, he receives a 50% capital gains tax exemption. John has been retired for 10 years and hasn't made any super contributions during those years. his super balance as of 30th of June 2023 is below 500,000. So, under the carry forward super contribution rule, the maximum he can contribute and claim as a tax deduction is $157,500. With a tax deduction of $157,500, John's taxable income is brought right down to $21,884, which is the effective tax-free threshold for FY24. As a result, he pays zero personal tax. If you're watching this in FY25, the effective tax-free threshold is $22,575, with the revised Stage 3 tax cuts coming into effect. Strategy number 7, self-managed super fund contribution reserving strategy. If you think strategy number 6 is juicy, wait until you hear this one. There is a way to use up to 7 years worth of concessional contribution cap to manage a one-off high-income event using a self-managed super fund. Building on strategy number 4 and 6, self-managed super fund members can use the carry-forward rule to utilize 5 years worth of unused concessional contribution caps from financial year 19 to financial year 23. Plus the current financial year 24's concessional cap. Additionally, they can use the self-managed super fund contribution reserving strategy to access financial year 25's concessional contribution cap, which is due to increase to $30,000. Therefore, the maximum one can contribute and claim as a tax deduction is $187,500. To make this work, the extra $30,000 must be put into their super in June 2024. In a self-managed super fund, subject to the fund's governing rules, the fund may allocate a contribution made in June to its members' account in July. This means the member can claim this $30,000 as a tax deduction in FY24, but the contribution amount will count towards the member's concessional contribution cap for FY25. This strategy is only available to self-managed super fund members. If you have a particularly large one-off capital gains tax event in a financial year, you may want to consider whether setting up a self-managed super fund to access this strategy is worthwhile. In our previous case of John, if he had a self-managed super fund, he could manage an even larger capital gains of $418,768 from the sale of the investment property and still pay zero personal income tax, because he can make an even larger personal deductible super contribution of $187,500. Obviously, we are taking this to the extreme. Not everyone is eligible or have that level of unused concessional contribution caps or that level of income. However, this is what these rules potentially allow. Even a less extreme application of these strategies can save you tens of thousands in taxes. But don't forget, money contributed to super is locked until at least age 60, and there is at least a 15% tax on concessional contributions inside super. If you're wondering whether there are other reasons to put money into super beyond the overall tax savings, watch this video right here.